Hi, welcome to T Minus Retirement, the podcast where we help launch your retirement into orbit. I'm Jay Cole.
And I'm Dustin Watts.
And in today's video, this is going to be more of an extension from our video last week when we covered what was finalized with the One Big Beautiful Bill. More specifically, this is going to be focused on for seniors and how they're going to be able to benefit from that new senior deduction. And so what we did was we just created a fake mock-up tax return just with an average senior that we normally work with. And then we're going to add this new deduction in and see how they're going to be saving on federal taxes. So it should be pretty good.
That sounds good, Jay. So before we get into the actual example of it, what were the biggest changes for seniors?
So really, it was only one change for seniors specifically, but for, we'll say, a married couple, if they're both 65 and older and their total adjusted gross income is below 150,000, they each get an additional deduction of $6,000 each. And so if you're single, then it's just 6,000 and that's it. Or if one spouse is 65 and one is 64, then you get $6,000 for that year, and then once the other spouse turns 65, then they'll get $12,000. So that's basically it. It's a deduction that's added alongside of either the standard deduction or if you're itemizing. So regardless if you don't have any itemizing, you're still going to be eligible for this deduction. And that was pretty much it.
And again, for those of you who are kind of wondering where that came from, that was really the compromised amount, I guess, of the no tax on Social Security. I know we had mentioned that in our last video and a couple of the previous videos, but no tax on Social Security was kind of one of those carrots that was dangled out there. Yeah. Ultimately didn't end up making it into the final bill, but this was the compromise, is to tax Social Security, but give you the increase of that standard deduction to give you some tax relief.
Yeah. And again, it's in addition to the standard deduction. So
right.
The only caveats are the age and then your income. But all right, so let me go ahead and share my screen.
So what kind of client are we going to look at here, Jay?
So we're going to look at a client. We like to joke around here. Our office is based in Temecula, and so we like to joke that the average client is Tom and Tammy Temecula. And basically, these are clients. They're both 75. So they've been in retirement for a little bit. They've been collecting Social Security for a bit. We'll go down what their current income was for 2024. So no wages. They're both retired. They're not working. They've got a little bit of interest, maybe from a CD or just from some investments that they've had. And then they've got some qualified dividends as well. And just to recap on qualified dividends, that means if you've held on to an investment for over a year or more and it pays out a dividend, then that dividend is taxed at a much favorable rate. It's actually taxed at the capital gains rate versus what your current tax rate would be. So we've got some dividends here, so that means they have a brokerage account of some sorts. Since they're both 75, they both have RMDs, and their RMD for the year was $25,000 that they had to take out. So that's going to be taxable just because it's money in an IRA that never paid taxes. They have a pension of about $50,000. And then on top of that, combined, they've got $50,000 of Social Security benefits that they get. And you can see here, so they got $50,000, but not all of it's taxed. $42,500 is taxed. So if we real quickly find out what that percentage is, that's 85%. So that's the max of Social Security that's going to be considered taxable. And so you can see here, when we come down here, their total income, $124,500. They don't itemize, they're just taking the standard deduction. So that's $32,300. So that means that we get to subtract this number from their adjusted gross income. And so From that, now we get their taxable income. That's 92,200. And from here, this is where we derive what their tax is going to be. That's going to be based off of the tax tables, and then also, um, like I mentioned earlier, some of that dividends is taxed at a long-term capital gains rate, so it's going to be taxed a little bit less. But overall, their tax is going to be $10,003, and that's it. So usually they'll have withholding or whatnot, and hopefully they can get a refund or break even. But this is just a nutshell of what an average retired client that we normally deal with have. So taking into
that's on the old tax law.
Correct. Yeah. So and this is one thing I forgot to mention too. So this is going to be applied. The new senior deductions applied for 2025 going forward. For purposes of just the illustration today, since none of the tax softwares have updated to include these new things, we're just going to use 2024's tax tables. The principle is still the same, but we just wanted to show more of an apples to apples comparison. So then here, we like to use this tax planner software within our firm. So their interest and dividend income is going to be the same. Pension and IRA, everything's still the same. You can see their Social Security is the taxable amount still the same.
So the right-hand column is the updated tax law changes for 2025?
Correct. Yeah.
Okay.
And then the left hand is going to be the current one. Okay. Now, again, for purposes of the illustration, we are going to use the 2024's information. So standard deduction is still going to be the same for 24. But then when you add that 12,000 senior deduction, your overall write-offs are going to be now 44,300, just because we're adding 12,000 to that standard deduction. So they get 12,000 more to be able to deduct from their income. Right off the bat, you can see their taxable income is less, 12,000 less.
Quite a bit, yeah.
Yeah, but more importantly, their tax is less. Okay. That's almost a $1,500 savings right there. So that's pretty substantial. I mean, I would gladly take an additional $1,500.
Yeah, it's no obviously having no tax on Social Security would have been much more to their benefit, but by getting that increased standard deduction for the senior deduction, it's saving the average type of senior somewhere in the neighborhood of $1,500, give or take. And I think that's a good illustration to give to people just so that they can see what they can kind of expect, at least conceptually, when they go to do their 2025 taxes here in another 6 or 8 months.
Yeah, and this is for a married couple, so it might be different for a single filer. But overall, I would say the average for a married couple, the savings is going to be around $1,500 or so.
Okay. Well, that's all good info, Jay. Anything else you wanted to share before we sign off here?
No, really the only other thing, the standard deduction for 2025, it's not 32,300. They increase it each year a little bit, and this is for seniors, but it's 33,200. So it went up just a couple $100. And again, this standard deduction is for a married couple where both spouses are over 65. They get that little additional amount for standard deduction.
Okay.
So 33,200.
Yeah, a lot of the tax softwares are not going to be as quick to update all the facts and figures as these laws get passed, but that's why we wanted to bring this example to you all, so that way you can at least conceptually understand what you could be looking at here when you go to file your taxes. So
yeah. So
we hope that you enjoyed the example.
Yeah. We'll as we get more information on things, and even more so information on how the other aspects of the new tax bill is getting applied, we'll definitely create more videos and show more examples of how it's going to be saving.
Yeah, that sounds good. Well, we hope you all enjoyed the video and the example that Jay presented. If you did like the video, please like, subscribe, and we'll see you in the next video.